Good afternoon, everyone, and welcome to a BFM webinar. My name is Roshan Kanesan. I'm the producer and presenter of Ringgit and Sense, BFM's personal finance radio show. And joining me this morning to talk about the impact of COVID-19 on retirement are Rajen Devadason, licensed financial planner with Manulife Investment Management Berhad and CEO of corporate consultancy RD WealthCreation, as well as Selina, licensed financial planner with Coreplus Advisory. As usual, co-moderating this discussion with me is Malek, founder of filife and founder of BFM Radio. First up, Rajen, Selina, how are you both doing this fine? Is it Tuesday? Yes, it is Tuesday afternoon.
It's a wonderful morning.
Selina, what about you?
Afternoon by now.
Selina, you haven't unmuted yourself.
Doing great, Roshan. Thank you.
All right. So just to get everyone on board again, what we'll be talking about today is retirement planning. This is not something for people thinking about retirement. This is not for the older vintage only. It's for everybody. It's, in fact, I think the adage is the earlier you can start, the better when it comes to retirement planning. Now, the three basic pillars we'll be tackling today will be: one, the basics of retirement. Let's get everyone on board and what this means, what this really looks like, because retirement planning on its own, it's a bit of an intimidating term. And then we'll talk about the impact of COVID-19, and a very timely, topical thing to get into. And finally, some of the principles involved in managing investments and portfolios on a personal level, whether to buy, sell, and hold, what are the strategies for long-term investing, and most importantly, some of the common mistakes that are made. So this is something we'll be exploring through the rest of the hour till 1:30, as well as addressing the questions that you have online. And please let us know what all the questions you want. Our two very capable panelists will be venturing into those questions while Malek and I just watch them work. So on that note, at 12:32 p.m. on a Tuesday afternoon, let's start with the basics of retirement planning. And Rajen, could we start with you on this? Could you break this down for us? When we talk about retirement planning, what does it really mean?
Hi, Roshan. Yeah, from my perspective, retirement planning is incredibly important. It's actually the area of specialization for my practice. But my practice itself is a financial planning practice. So what I think would be more useful is for people to first understand that at its core, financial planning is the process of meeting your life goals through the proper management of your finances. Very simple, no rocket science, really, really direct. And when we talk about our life goals, there are many goals. I just found out today that Selina has got 4 children. I'm assuming she loves them all. And that probably means that she wants to educate them to the best of her ability. And so one of her core life goals will be to be able to educate her kids to the highest capacity. My wife and I have been married a long time. This year will be 22 years if we get to October. But we've got no children. So we don't have kids' tertiary education. But we have obviously a goal to retire well, just as Selina and her husband would, just as Malek and his wife would, just as Roshan, I don't know who your better half is, but just as Roshan has. So basically everyone listening, we've all got a key goal of wanting to retire well. The definition, of course, is what is retire well? And very often we hear people talk about, I want to enjoy my golden years. And that immediately tells you that what you actually want is to have a wonderful time in retirement. And I think it is absolutely possible. Selina actually is our resident expert, I think, when it comes to the aspects of creating a money mind among the young adults. So, you guys should ask her questions about that later. But the truth is, when it comes to retirement planning, you want to start as early as possible. When is the best time to start retirement planning? Yesterday. Failing which? Today. At least start thinking about it. But the bottom line with retirement planning is to make sure that you work for as long as you are able to and you want to. And you don't end up in a situation of having to constantly keep working long after your body and your mind start to wear down, simply because you don't have the cash to be able to sustain your lifestyle. The best situation, I think, is for us to be able to identify what our passion is, what we were put on this earth by God to do, and then to do it for as long as we possibly can, but not to have to constantly do it for money. So I hope that helps, Roshan.
Yeah, definitely, Rajen. But when we talk about retirement planning, the term itself, brings up things like EPF and PRS and all sorts of pension plans, and it's quite intimidating because it's a very complicated world, right? Finance. But really, when it comes down to it, it's when you say something like start today, it really is something as simple as creating a new bank account on the side and saving money in that just for retirement, right? That's the first step. It's a baby step, but it's the first step in that long journey. And I think that's where we get caught up a lot of the times. We're like, oh, retirement planning, we've got to get it correct on day one. So I'm going to keep planning, but never execute. And then you never get the benefit of compounding interest. Now, Selina, do you have anything to add to the basic thinking around retirement planning that hasn't been already covered yet?
Yes, actually the idea is very simple. For retirement planning, I only have one great advice for everyone. Okay, when do you start retirement planning? The answer is simple. You start as soon as you can. Okay, ideally, the day that you should start planning for retirement is the day you get your first paycheck. So imagine if you're as young as 18 or 20, if I had, that lead start, you will have all the time to start building good habits, and compounding your savings. And the sooner you begin saving, the more time your money has time to grow. The more time your money has to grow. You see, so start early. If you have, you have the advantage. Start now. Okay, if you didn't start yesterday, like Rajen said, why not today?
So essentially, it's that when you get that paycheck in, you start partitioning a part of that for retirement purposes, that retirement goal. Malek, you want to add something to that as well?
Yeah, it just reminded me of a conversation with my daughter yesterday. I think she is 19 years old, and yeah, we started talking about her, not necessarily retirement, but her life goals and how to finance it, right? So it was a wonderful conversation, and you're right. I think they are, unfortunately they have a father who is very interested in financial planning and and so on. So they get a lot of this from me. So yeah, so I think it's I agree with you completely, Selina. There's never too late a time. My 19-year-old, my 16-year-old, and my 13-year-old are all on Stashaway, right? So that's one part of that sort of planning, financial planning that that they can see for themselves. So and they're happy. They kind of like and the other thing they're taught by is this thing called Animal Crossing. Animal Crossing. This game is a very popular game. You buy turnips. You buy turnips on a Sunday, and then you sell it on a day, so they bought turnips for $102, they tried to sell it for 140, 150, right? Not if financial planning in stricter sense, but it's an introduction. So just to confirm Selina's point.
Malek, just to follow up that, what were some of her more interesting questions about retirement planning? Did she have anything that really you thought were particularly curious?
I think for her, I think the more immediate goal was my daughter was actually, how can I afford property? Dad, it's crazily expensive, Dad. Will I have to live as a thing? So I guess there is intermediate life cycle. So I think in her mind first is about her immediate future after she graduates from university. But I think we go along so that's what her goals were. So I think we were just talking about financial planning as a whole. But I think I also had the opportunity to slip in a little bit about so I use my example as someone who has to plan for my retirement.
Yes, in fact, in these times of crisis, financial crisis, we can actually use it to our advantage and turn this crisis into teachable moments for our children, and talk to them, tell them what are the events that actually led up, to the current situation, okay? And use this opportunity, okay, to teach your kids the value of money and how important it is, to shop savvy, what are the difference between needs and wants, what is borrowing money all about, okay? And even if you instill even a partial sense of financial literacy in them, you have done a great job. Even a partial sense, it is a lifelong learning for them. It's very important.
Yeah, definitely. As a child, I've talked to my father and my mom about this, and things like even when this crisis first broke out, it's actually quite nerve-wracking if you don't have someone to tell you about previous things that have happened. So I asked him about 1997, and I gave some context to the situation because 30 years old presently, I've never, as an adult, gone through a financial crisis or any sort of volatility. 2008 really didn't impact us as much as the rest of the world. But one of the big questions that comes up when we talk about, so retirement planning is one financial goal. You can have many, whether it's to buy a property, whether it's education for your children, retirement is one. The big question when it comes to this goal, though, is how much do you need? I mean, sometimes it's good to have a ballpark number to aim towards, or at least know how to calculate that. Rajen, what are your thoughts here on that?
It's a very good question. I think the short answer for most of us is, how much money do you need? More than I actually have, more than I'm likely to have. That's how a lot of people feel. Maybe later in this discussion, I'll go into the nuts and bolts and talk about things like capital preservation and capital liquidation models for retirement funding. But for now, let me just say that, God willing, if I make it through a couple more weeks in this month, I will turn 56. And I remember when I was small, hey, thank you, Malek. When I was small, and actually it's true for all of us, the standard retirement Malaysian age in Malaysia was 55. I mean, that's what we grew up thinking about. And then many years ago, the government got it right first. The public sector started moving its retirement from 55 to 56, and then 58, and then to 60. And then the private sector did one jump from 55 straight to 60. Now, when you look at what the standard retirement ages are throughout the world, in most countries, even at 60, Malaysia has a very early retirement age. The normal range seems to be between 62 and 68. I want to answer your question, how much is required? Depending on how old you are, depending on where you wish to retire. Malek, for your 19-year-old daughter, because I live in Seremban, I am speaking to you now from Seremban. Can I just point out that the price of real estate in Seremban is very, very low compared to KL, or Singapore, or wherever else. So, one idea is buy something in Seremban. The other one, of course, Malek, is if she's interested in real estate, property, and if wherever she ends up going, if property is just prohibitively expensive, then one thing to look at would actually be REITs, real estate investment trusts, or REIT funds. But again, Roshan, we can dive into that. Bottom line is, how much money is required? For 85% of my clients, using both the capital liquidation model and the capital preservation model, both models of which I will elaborate on later, 85% of my clients need between 500,000 ringgit and 20 million ringgit. And that's a huge range. But it depends really on how old they are, where they want to retire, and also their lifestyle aspirations.
All right. And Selina, we already addressed that kind of the aspect of when to start. But maybe we could also touch on how to start, just simple first steps in your view of how young people can just start the process of building their retirement portfolios 40, 30, 20 years down the line.
Rajen?
No. Rajen?
I'm sorry. Was the question posed to Selina or to me?
Yeah, initially I posed it to Selina. Just talking about when to start. The earlier, the better, right?
Correct.
Yeah. So do you have any simple suggestions of just how to start, whether it's just setting money aside, things like that?
Selina, you want to go or shall I answer?
Oh, yeah, carry on, Rajen.
Okay, right. Malek, you want to say something?
So I'm just going to incorporate this with another Facebook question. So that ties in with the Facebook question from Yo Tian Lun. He said that to get the current Gen Z to know about financial planning aware and learn about financial planning is a challenge. I guess the question is, how do you educate a Gen Z and younger about financial planning? And I think, Selina, you already alluded to it. I mean, like, use opportunities like MCO. All of us are budgeting really well on our expenditure. We're all talking about incomes and all that. So I think the MCO is a great opportunity to educate young ones. I use the example of Animal Crossing as buying turnips. And the Animal Crossing is fantastic. You actually, you have some pretty crazy landlords and owners of islands, so that you have to like deal with. So games like that actually is quite interesting. It starts out the conversation. And then we come back to Roshan's question about, you have 20, 30 years ahead of you. You're in your late 20s, maybe early 30s. When you talk about retirement planning, how would you kind of like approach a client who is in their sort of late 20s?
Okay, great. So Roshan, remind me later to go back and answer, give a little bit of input into Mr. Yo's question, because he was talking about Gen Z or younger, which I think is going to be called Gen Alpha, actually. So it's Gen Z, Gen Alpha. But, and I do want to answer that. But right now, for young working adults, may I suggest Roshan was absolutely right. Don't try and get too fancy, okay? Just get to the point where you effectively have some money set aside. Those of us in the private sector have money in EPF. Malaysia has approximately, I think, 1.7 million civil servants. I would imagine maybe 1.5 million of those actually qualify for a government pension. So Stephen Covey taught all of us a long time ago that we should begin with the end in mind. So whether you are a teenager, whether you're in your 20s or in your 30s or in your 40s or in your 50s or in your 60s or older, and you're still working, hypothetically speaking, wherever you may be right now, think about the type of retirement that you want to live, and think about the lessons that we can extract from this particular crisis. And actually, either if you're old enough or if you have done enough reading, then you can get a sense as to how things panned out for different people in different crises. In terms of my own adult life, I was 23 years old. I was in London in 1987 when the October 1987 crash occurred. The Dow in one day fell 26%. Now, I wasn't in New York, I was in London, and because of the weekend and the delay, I remember getting up early in the morning and going for a run and trying to figure out why on earth I was hurdling over tree trunks that had fallen down. London had been hit by a hurricane. And as a result of that, trains were slow getting into the city of London, and a lot of people, a lot of traders couldn't get in to sell, and that actually minimized the drops in the market. And I went through 87, but I had no money, so I wasn't invested. And then if we scroll forward a decade, I was back in Malaysia, I was working. 1997, 1998, Asian financial crisis. It was catastrophic, very, very bad. And then, of course, we had the boom years of 99 in the US, where everyone was throwing out all kinds of earnings metrics, and it was just eyeballs with the dawn of the internet. And then the dot-com bubble occurred in March of 2000. And then, of course, 9/11 occurred in 2001. Global financial crisis, 2007, 2008, 2009. And then now this. These I lived through. And so I saw the people who suffered and I saw the people who prospered with my own eyes. In a book that I worked on with friends of mine 22 years ago, Financial Freedom 2 through Malaysian Equities and Unit Trusts, I had to look at 200 years worth of investment data. And the bottom line is this. If you want to make money over the long term, you have to be invested in equities. You have to be invested in businesses. But when we hit a mega crisis, not a marginal crisis, but a really, really deep crisis, like the Asian financial crisis, like the global financial crisis, like this COVID-19 crisis. When that happens, what you find is liquidity dries up. Now, the irony is this. The central banks of the world have been pumping money, and they have effectively pumped in as much as $8 trillion worth of stimulus money thus far. That is so much money that is actually about 10% of global GDP. And it's not enough. More is going to be printed. And you would think that with the whole world awash with liquidity, plenty of liquidity, very easy. But let me ask you, the people who are suffering, many of us have actually seen the long queues in these WhatsApp videos of people queuing up, and then you find that they're there to sell or to pawn their gold in pawn shops. It's heartbreaking. And yet you think about it. These are the ones with gold who have something they can convert to cash. What about the many people who have no cash? And so it seems to me time and time again, every time you hit a crisis, even though it doesn't make rational sense to hold too much cash most of the time, in a crisis, you must be cashed up. So to start with, Roshan, in terms of how do you plan, start with cash savings, look at the future and figure out at the end of your retirement, are you going to rely solely on a pension? Or most of us will not have a pension. So are we going to rely on our EPF? Will that be enough? EPF does a remarkable job. Established in 1951, one of the biggest superannuation funds in the world, one of the best run. And yet even EPF comes out and says, you know, you can't rely solely on your EPF money to have a great lifestyle because of longevity risk that we live too long. And so what we need to do is take personal responsibility. So we start with cash savings, but we also need to teach ourselves. We need to learn about bonds, about the fixed income market. We need to learn about equities. We need to learn about investment real estate. We need to learn about the alternative investment space, understand commodities. So it is a fascinating journey, but you must start. Now, Roshan, I don't mean to interrupt you, but remember, I still want to answer Mr. Yo's, I think it's Mr. Yo's question about the kids. But did you want to say something just now?
Yes, I just wanted to touch on the fact that this crisis, we're talking about cash flow and crunch and all of that, but maybe we could quickly address Mr. Yu's question first before we move on to the next part. But within maybe like a minute, because
Sure, very quickly. Over the years, I've actually had the opportunity to teach little kids, sometimes like very little kids, like 6, 7, 8 years old, sometimes teenagers. And one of the best things I have found with regard to teaching children about money is to first give them a regular allowance. Now, if they're very small, give them a little bit of money every day. If they're a little bit older, once a week. Once they're old enough to handle it, give them a monthly allowance. But I have found that it is very helpful giving them an allowance in a ringgit quantum and a ringgit amount that is easily divisible by 3. So maybe a little child, maybe you give 30 cents. So 3 10-cent coins. Or older child, you give maybe 3 ringgit. So 1 ringgit, 1 ringgit, 1 ringgit. The purpose of making sure it's divisible by 3 is go out. I have no shares in any piggy bank business, but go out and buy 3 piggy banks. Give to each child and teach your child that you've got 1 piggy bank that is for generosity, it's for giving. You've got another piggy bank for saving, which will eventually turn into investing. And your last piggy bank is for you to actually spend on yourself. If you can do that when the kids are small, when they're 5 years old, when they're 10 years old, when they're 15 years old, when they're out and they're working for the very first time, they don't suddenly think, oh, wonderful, my gross salary is what I have to spend, which, by the way, is never true because we always have deductions. So I hope that helps.
I know, I think it does a good job of contextualizing, especially when you get that lump sum of money, especially when you get your salaries and then you start to not sure what to do with that money. But when we speak about cash, now for those who've just joined us, we're now at about 250 viewers online. Thank you for taking the time to speak to join us today. My name is Roshan Kanesan. I am the producer and presenter of Ringgit and Sense, BFM's personal finance show. Co-moderating this discussion with me is Malek Ali, founder of filife, and our 2 panelists today, Rajen Devadason, licensed financial planner with Manlife Investment Management Berhad and CEO of RD WealthCreation, as well as Selina Dang, licensed financial planner with Coreplus Advisory. Now, I want to turn the conversation over to, we brought up pawn shops a little earlier. I think one of the big questions that has come about right now is managing cash flow. I think that's a big thing, not just for businesses, but for individuals. And it's become, and we've addressed this, I think, for families, for individuals, but for retirees, how important is cash flow management at this point? Is it more, is it less? I think I know the answer, but I think I should leave it to you to address this, Rajen.
Repeat the exact question again, please, Roshan.
How is cash flow management, how important is cash flow management for retirees at this point?
Absolutely essential. One of the things that's really, really surprised me throughout this particular crisis, we're already into May, and really we've got to think back to the middle of March when basically the whole world imploded. Every single asset class, except for cash, every single asset class. And I'm talking about stocks, I'm talking about bonds, I'm talking about gold, I'm talking about cryptocurrency. Everything collapsed. And again, based on the normal understanding, it is unwise to hold cash because we live in an environment where fiat money is issued by every government, and fiat money has got nothing to do with, the famous Italian car company. What's basically happened in terms of the evolution of human society and economic transactions is that we have gone from barter trade. Let's say I've got some eggs and Roshan, you've got some fish, and I want some fish and you want some eggs, and we trade. But once the transactions get more and more complex, money had to come into the picture. The first round of money was basically commodity money, coins made from silver, coins made from gold. The money itself was valuable. And then what happened, I tend to think of this as the Robin Hood effect. If you remember the stories of, the fat rich people going through in a carriage through Sherwood Forest, and they are relieved of their money by Robin Hood and his merry men. And so because of the Robin Hood effect, carrying gold, carrying silver became unwise. Then I think it was the Chinese who actually invented representative money. Representative money basically means I've got a piece of paper, it's a note, and you take it to the de facto or the real central bank, and I will trade with you. But I want you to think about the development of humanity. For most of human history, the world has had fewer than 1 billion people. In the year 1900, we had 1.6 billion people. In the year 2000, 1 century later, we had 6.3 billion people. In 1 century, the magic century, the 20th century, if you like, we went fourfold. And yet the amount of silver that's come out of the ground hasn't grown that much, because silver is an industrial metal. We have basically used up 90% of all the silver that we've ever pulled out from the ground. Gold, most of it we still have, but there simply isn't enough gold above ground to deal with the transaction. So we actually moved from representative money to commodity money, also to fiat money. Fiat money is, if you think about it, really worthless. And I caught a glimpse of a question that was relayed through. Someone's actually saying that Robert Kiyosaki says, savers are losers, etc. And you can take that with a little bit of salt, because I believe there have been situations in Kiyosaki's own corporate life, at least, where he has run out of cash and he has had to declare bankruptcy. I like a lot of Kiyosaki's teachings. But I think it's important for us to understand, just as the human body, to be healthy, requires a strong circulation of blood, an economy needs a strong circulation of cash. When we talk about growth of GDP, we're basically looking at various factors, but one of them is actually the velocity of money. And in a crisis, everyone gets scared and liquidity dries up. And in this situation, it's weird because there's $8 trillion worth of fresh liquidity created just in the last couple of months. And yet, talk to the airlines. How many airlines have already folded? I really hope MAS gets the backing of the government. I really hope AirAsia, even though it's a private entity, has some kind of backing, because quite frankly, AirAsia is a Malaysian product. AirAsia has put Malaysia on the map, and AirAsia serves an entire community. But the airlines around the world simply don't have liquidity. Individuals, the people queuing up, no liquidity. And so that's why I think it's very important that people raise cash. And in retirement, this crisis will pass. And maybe it'll be 5 years or 10 years before we hit another crisis. When the next crisis comes, can we look back on this crisis and say, I had a hard time, but I learned my lesson. And I built up savings, I built up investments, I diversified, and I am in much better shape. Even if you go all the way back to the Great Depression, which started in October 1929 and lasted pretty much to 1939, before the beginning of the Second World War, most people suffered during the Great Depression. Started off in the US, spread across the world. The people who survived, the people who thrived, were those who actually had cash. So 2 things. The 2 lessons that you want to learn from this crisis: make sure that you have high cash levels, and you want to have low or no debt levels, because debt is a risk and debt creates stress.
Yeah, so I think essentially the key here is that the retirement planning needs to take into take into mind the cash flow management and all of that. So I guess this brings the question now, or at least the conversation, to over thinking about retirement planning. How should, especially if your retirement funds have been hit, how should you be thinking about retirement planning? And I think, Selina, we're going to leave this to you. How should people be thinking about retirement planning in general, especially in this time, with the impact of COVID-19? Selina, I think you're on mute.
Thank you, Roshan. Yes, so we will actually look at how the present pandemic, the COVID-19 pandemic, will actually affect the retirement of the ordinary Malaysian. Okay, so we know, as what Rajen has been telling us, that the world has been in a panic since the outbreak of the coronavirus, which caused almost unprecedented market volatility. Okay, so while we do expect a turnaround as soon as the health risks have been mitigated, either through a vaccine or treatment, but it is still important to have a plan in place to protect your financial future, especially if the economic damage of the virus takes longer to resolve than the medical crisis itself. So how will COVID-19 affect your retirement, and how should you react to the current state of the market? Okay, so we can actually look at it based on 3 silos. So if based on your retirement schedule, if you're already retired, you're in retirement now, enjoying your retirement, okay, it is imperative that you allow the income planning and your generation process to just run its course. If you did a good job in your retirement planning and you have a strategy for your retirement income, keep the strategy, okay? And it should ideally have been designed so that any of these major events in the market would have a minimal impact in the long run. Well, on the other hand, if you do not have an income strategy or you're unsure what it is, maybe it is a good time now to sit down and think about it. And if you really need help, talk to a licensed financial planner. Get someone to help you, someone who you trust that can help you overcome this. Okay. Now, in the second part, the second silo, yes, Malek, you were saying.
Yeah. So I just want to interject here. I think you said about someone who has an income policy, but I guess you probably will suffer 1, maybe 2 quarters of lower dividends, right, during this time. Is your advice to just ride it out for now? If you have a good thing, just be able to like, let that income policy continue, and then just let that, just swallow that dividend cuts for the next couple of quarters, perhaps?
Yes. So what is important now, in such crisis is to keep calm. Don't panic. All right. That's imperative. That's very, very important now. And if you have if you have a solid financial plan, you should be able to ride this crisis out. There shouldn't be a problem for you to ride it out. Yes. Just maintain what you have now. Okay. And just keep your strategy for your retirement income. All right. Now, moving on, all right, we move on to those who plan to retire within the next 10 to 15 years, okay? Now, if you're planning to retire in the next decade or so, okay, you should already have assets positioned for future income. So at this point, there's actually a chance that you'll be receiving less than, what you expect from your retirement funds, okay? Hence, it is now a good time, okay, this crisis period is actually a very good time for you to check on the planning that you've already done. And it is actually a very good idea to make sure that you do not over-rely on your retirement funds for retirement itself, okay? Now, a dramatic market plunge can actually, sorry, yes.
Yeah. So Selina, I'm just going to a question here. Someone here on Facebook, Mr. Marcus Lowe, said, so, in relation to your point about retiring in, 10, 15 years time, he says here, what advice would you give to an age group of 50 years and above on how to invest to make returns in such difficult times? I think that's his question. You're 50 years old, this is happening. How would you respond to Marcus?
Yes. Hi, Marcus. So, Marcus, view this crisis as a huge window of opportunity. Keep doing what you've been doing. You save, you spend, and continue to invest wisely. Okay, which hopefully also means still making regular contributions to your retirement accounts. Okay, Rajen, maybe you have something to add to this question? Yes.
I do. Marcus, you and I are in the same group. So right now I'm 55 plus. I'm going to hang on to the 55 bit until I turn 56 very soon. Mm-hmm. And the question you got to ask yourself is, what is your target retirement age? Selina and I were actually discussing in the last couple of days, just getting ready for this very exciting event. We're very honored to be here. So again, Malek and Roshan, thank you for having us. But we were talking about this concept called FIRE, which, and I can never remember. Selina, what does it stand for?
It is Financial Independence Retiring Early.
That's right. Financial Independence Retiring Early. Roshan, I believe you interviewed me once specifically on FIRE. Is that correct?
We talked about it for sure.
Okay. So, if you don't know, go to BFM, do a podcast and search for that function and, that search term and you'll get that. But I actually do not like the idea of FIRE. I think FIRE is irresponsible. I think it is dangerous. For those of you who don't know, FIRE is a situation where people take, they work very, very hard in the early decades of their career. And then some people will try and retire maybe in their late 30s, early 40s. And I just think it is such a waste of human potential. If you love your work, and quite frankly, how many people right now, unfortunately in the workforce, hate their work? And usually if they hate their work, it's because they hate their boss. Most people leave companies because of the people around them, or most likely people above them, and not because of the job per se. So I think if you're in a situation where you hate your job, hate your boss, etc., don't quit right now, because job is super precious in this environment if you can still hang on to it. But certainly figure out a way to recalibrate your life and figure out what it is that you enjoy doing. Now, once you get to that point, it may require starting your own business, but be very, very, very careful. 90% of businesses around the world that are started will fail. Global stats. And that doesn't mean don't start your own business. It means start in a prepared manner, start low, start often. If you fail, fail small, don't fail big. But the purpose is this: if you are able to find passion in what you do, why would you want to consider retiring, say, at 55 or at 60 or even 65? Now, I based on my mother's side, my late mother's side, my late father's side, statistically speaking, I have longevity risk. That means I'm likely to live longer than shorter. I love my work. My goal, God willing, if I'm functional, is to aim to only start thinking about, or just to aim to retire at the age of 75. So because I turned 56 this year, that gives me 19 more years. And I expect these to be the best years of my life. Not everyone is in the same position. Most of you listening are much younger, but I would say look for passion. And with regard to those in their 50s and you've got a fixed retirement, let's say you don't have much choice, you have to retire at 60, I would say this: I am incredibly uncomfortable at how high the risk-on markets have stayed in the midst of what is likely to be possibly another depression. And so I think what will happen in markets is there will eventually come a point of capitulation in the next maybe 2 or 3 months. I'm not really a market timer, but I think that's what's going to happen. So when the point of capitulation is reached, markets will suddenly dip. Before that happens, maybe what you should do is trim your risk-on positions to raise your cash levels. Malek, earlier you were talking about what happens when your passive income plan results in a drop in dividends, let's say, or maybe if you've got rental property and your tenants are suffering and you love your tenants because they're really great tenants, so you actually agree to reduce their monthly rental. When that happens, if you have a stash of cash somewhere else, a large, deep pool of liquidity, you can basically power through. So that's what you need to do. So I don't know, the person who asked the question, I don't know your specific circumstances, but certainly from an investment perspective, Selina was right. If you've got excess cash and if you've got excess cash flow, there are going to be great opportunities, I think, over the next, say, 3 or 4 months. There will be prices that are very, very low. And I would say focus on trying to get to the point where you really do begin with the end in mind. Like, once again, I'm quoting Stephen Covey. Whatever your retirement age may be, target retirement age at 60, at 65, at 70, mine is 75, whenever it may be, at that point, how do you want to live? Where do you want the cash to come from? And chances are, these are my notes, you basically might have some cash coming in from a state pension for a small fraction of Malaysians. A much larger group, money will come from EPF. If you take money from EPF, you want to set up a portfolio that will create a stream of income. Don't go and spend all of it at once. Or you can actually decide to keep all or some of your money in EPF and have EPF send you money every month. You will have bank savings, and bank savings will generate interest, or if it's Islamic banking, you'll get your profits, but it works out pretty much the same. Interest rates will fall. Bank Negara, I think, either just has or will very soon cut interest rates yet again. So those of you who are real FD warriors, you're quite upset because you've gone from 3% to 2.5%. And trust me, we're going to get to 2.0 and 1.75 soonish. Thankfully, Malaysia still has margin. We're not going to go negative, I don't think. Sorry, Malek. Let me just finish this. So bank savings will give you interest. If you buy the right stocks, you get dividend income. If you buy unit trusts, you will get a distribution if you structure it correctly. You will also have your PRS, private retirement scheme, and you might also have rental income. So begin with your end in mind. Know that you want multiple sources of passive income coming through. And as a result of that, begin to lay the foundation to get those things working. Malek, yes?
Yes, this is a question from Facebook again, a guy from Nix Lee. So we've dealt with, I guess, folks who are in their 50s. There's another question, and I'll put this forward to Selina. What would a plan of action be for someone in their 40s under the current environment? You know, markets have gone down 25% and then went up 10%. Now we were like, sort of uncertain. Warren Buffett has sold all his airline shares. I feel sorry for AirAsia X subscribers in the early days who took loans for it. I mean, that's a very horrible environment to be in. But say you're in your 40s, what do you do now? Selina?
That's right. If you're in your 40s, I would say congratulations. You have a long runway, okay, to plan for your retirement. Okay, you are in an advantage position basically now. So what's important now, again, is you need to have a solid financial plan in hand. If you don't have a financial plan, please go and get one. Okay, it's a huge window of opportunity for you now. From 40 to retirement, saying 65, you have a good 25 years in front of you. Okay, now work with a financial planner. Okay, think about your retirement plan. Okay, and work out your financial goals. Okay, work out the budget, your cash flow. Okay, think about where you want to go. All right, and things will be okay. In 25 years, it's more than enough time, basically.
Okay, and so when it comes to the retirement schedule, I think that really is in line with what you were talking about earlier, Selina. We talked about already retired. This is the long runway, and people planning to retire. These are the three silos, correct?
That's right. And what is important actually, sorry, Roshan, just to add on, okay, one very good strategy if you're in your 40s, you can always think about investing in a dollar cost averaging based portfolio. Okay, because we can never time, when to buy. We do not know. We can never buy or invest at the lowest point. But when you actually adopt a dollar cost averaging based portfolio, in the end, you will get the lower average price of your investment.
Yes, dollar cost averaging is, I think, my favorite strategy. It's a lot less intimidating than buying anything at these current valuations. But if you split your money, you kind of break out that concentration risk, which is, I think, for a lot of people, like for myself, that concentration risk when you invest is very scary, right? If you buy one share of something. So having that strategy is very helpful. Yes, Malek.
Yeah, I just give an example of my personal, when you talk about dollar cost averaging, let's say the index in, I guess, February 14th was 100, right? I guess when the markets tanked, I dollar cost average at I guess about 80, at 85, and then a dollar cost average at 80, and I dollar cost average at 75. Net, I end up at about 83, right? Now it's back to about 85, right? So wow, but it was a scary time. But I guess the fact that you can dollar cost average really helped it out, and sort of bring in the low was 75, but at least I got in at now my average cost is 83. So I'm not sure whether that example is easy to understand. Over to you, Roshan.
Yes, may I give some input?
Yes, please.
Okay, what Malek was describing technically is not dollar cost averaging, it's actually averaging down. I teach this, so very often when it comes to understanding dollar cost averaging, 5 criteria must be met, 3 of which you will find in the textbooks, 2 of which people don't talk about, but it's very important. First, you must buy high quality assets. Do not buy rubbish. Criterion number 2, you must buy high quality assets that fluctuate in price. If you want to talk about high quality assets that do not fluctuate in price, maybe money in ASB, money in EPF, money in fixed deposits. That's great savings, very steady, but it doesn't fluctuate in price. So technically it won't be dollar cost averaging. So high quality fluctuates in price. After you've taken care of those 2, which most people don't talk about, then you get the standard 3, which come in the textbooks. You need to invest equal amounts of money, 100 ringgit, 1,000 ringgit, 10,000 ringgit. Criterion 4, you invest at equal intervals, most often once a month, could be once in 3 months, could be once a year, could be once in 43.6 days, don't really care, must be equal intervals because the purpose is to strip out emotion. And criterion 5 is the most difficult, regardless of market conditions. That's why you have to buy high quality. When we hit a mega crisis like 87, like Asian financial crisis, 97, 98, global financial crisis, 07 to 09, right now, everything falls. Markets will eventually recover, but the rubbish that falls will stay at 0. The good stuff will come back. So hopefully that helps.
So I think one thing, a term that came to mind when you were talking, Rajen, is basically value traps, right? Some stocks, some assets will go down, and with that, those are the things that you look at it like, oh, this is it's cheap, but sometimes some businesses are cheap for a reason, and you don't want to buy a discrete company back in the 97 if it was cheap, right? Essentially, I don't know if anyone knows what a discrete is at this point. So that, I think the dollar cost averaging it's a very important thing to help people start as well, because it's less intimidating. It helps to, if you have a limited amount of money, you can distribute that over time, and it's mechanical, right? It's the constraint of you have to do this each time. It's kind of what you do with your EPF savings every month, right? No matter what, a certain percentage is going into that EPF account. Now we're about 15 minutes away from 1:30, and I think we're going to get to some questions right now that Malek has nicely lined up for us. Malek, what's the first one we want to address?
Yeah, so here is something from Roshni Rajasingam. I'm of the view that fixed deposits during this period is the best option. Is it? I think that's one thing. And tie in with that is a question about, do you all agree? Someone then says, a guy, Shouter Ismay says, do you agree that real estate is more stable as compared to other forms of investment, e.g. stocks, bonds, or shares? So there is this general question, I guess, about asset classes, right? Fixed deposit, cash. You have someone talking about property. We had, Kiyosaki mentioned. We have also equities. I think there's a question about asset classes. And what's your general advice about asset classes when we have a crisis like this? Rajen.
Got it. Once a year, there is a report that is developed and published by a wealth management company, a wealth consultancy called Capgemini. It's called the World Wealth Report. You can get it for free. So remember this, World Wealth Report. Most years, not every year, the World Wealth Report actually has a table, a chart that shows where the world's wealthiest people, and this is not the Forbes billionaire group, okay? These are like regular people. Malek definitely fits in that category. Regular as in more than $1 million US to invest. By Malaysian standards, that's a lot, 4.3 million or more, and all the way up to the Buffett class. So what it does is, it does an analysis of where these people, they're known as Hanwis and Ultra Hanwis, high net worth individuals and ultra high net worth individuals. Hanwis range from 1 million plus US to invest up to just under 30 million. Ultra Hanwis are 30 million plus onward up to the billionaire class. And the analysis looks at the 5 asset classes that people invest in. And those 5 asset classes are the exact same asset classes I talked about earlier. Cash and fixed deposits. Was it Darshini, you said her name was, the lady who was asking?
Roshni, I think.
Roshni.
Hold on, let me check.
Well, Roshni, yeah. Okay. So yeah, Roshni, let me just say that I have money in fixed deposits as well. And you know what I tend to load my fixed deposits with? Money that I owe the Malaysian government, because I do not want any situation where I have to scramble to be able to pay my taxes. So, but in addition to that, I also have money in FD, but I also have cash in money market funds. And I love the fact that it gives me stability. But the reality is Bank Negara is dropping interest rates. And so the trade-off is that, yes, you've got safety of principal, but you're guaranteed to lose money in the long run because of inflation. And the only way to beat inflation in the long run is to actually invest in risk-on investments. Now let's come back to the 5 asset classes. Cash, fixed income, meaning bonds, equities, investment real estate, and alternatives. Think about commodities, let's say, just to keep it simple. When I'm talking to my clients and I'm explaining this, I tell them, look, I will structure a simple portfolio for you, maybe 3 asset classes: cash, bonds, and equities. If they want a little bit more, I do cash, bonds, equities, investment real estate. They want more: cash, bonds, equities, investment real estate, commodities. To be able to beat inflation in the mid to long term, you must not just focus on cash and bonds. But in this environment where interest rates are coming down, there is a relationship in finance that you can actually very, very wisely start to harvest, take advantage of. When interest rates come down, bond prices rise. Strangely enough, REIT prices rise as well, real estate investment trusts. So with interest rates coming down, you got to ask yourself, do you want to shift a little bit of your cash into bonds and into REITs in particular, if you want to make short-term money? Now, for many of my clients, when things really started to collapse in February, March, even by February, I was getting nervous and I was making changes. It was clear that the world was slowing down. So I expected interest rates to come down. Therefore, I started moving money into bonds and into REITs. And then mid-March occurred and everything crumbled. And I moved even more to REITs. But then it became clear that this economic crisis is going to be so bad that some tenants are not going to be able to pay their rent. As a result of that, I moved to safety and I did REIT bond. And then I realized, credits could come under tremendous stress. And for a while, I moved to cash. I love cash. I love the stability of cash, but I do understand the importance of taking care of long-term investments with risk on asset classes, so that in the long run, you do better than your personal inflation rate.
That was very comprehensive, and I think it really does illustrate the point of that volatility that we've seen in the first quarter of this year till today. So Malek, do we have any other, or Selina, do you have anything to add to that before we move on to any other Q&As?
Yes, actually, I would just like to add a little to what, the asset classes that Rajen was mentioning about. So there's always a myth that whereby, many say that when you are retired, okay, you should, not be invested in any more equities, okay? So, in this case, I would like to say, do keep some stocks, even in retirement, because you need your money to grow. Okay, you need your money to continue to grow even in retirement, and stocks can actually provide that growth. But then again, please be very careful with the stocks that you invest in. Go for the blue chips, the high quality ones, not the trash. Okay, and once you have a properly allocated portfolio, okay, then you can actually see how equities can actually fit in even in your retirement portfolio. Okay, you can create an income plan, okay, that will actually give you monthly distributions from the dividends that these stocks will give you. Okay, so think about it. Even if in retirement, you can still have some equities in your portfolio, not only cash and bonds. Okay.
I'm going to ask specifically two asset classes that are mentioned on the Facebook platform as well. They say there's a comment by Eric Wong saying properties is the best investment, and then it has a question about why people can't, pay for the installments. So property, I think we also had mentioned about Robert Kiyosaki as well. I think that has, I mean, he has infiltrated so many people's minds. But he's in a way. But I think that's it's a double-edged sword, because I think there's some stuff in there which is a little bit scary for me. I think. So properties. Let's talk about properties. Should that be part of your retirement planning portfolio? Getting rentals. The classic thing is people say, "Well, I'm going to buy a second property so that I can rent it out, and then I can retire on the income from the rental." What is your thoughts on that, Selina?
Okay, in any portfolio for that matter, you can have a good mix of all the various asset classes, and property is one of them. When coming to retirement, actually, and I would like to bring to attention, there's actually, you can actually go to moretolife.com and you can actually look at their home equity product, which is actually a very new product now in Malaysia. Okay, and it's actually similar, okay, not the same, but a similar concept as the reverse mortgage, okay, whereby they actually allow you to stay in your home and convert your property into a stream of payments to fund your retirement. Okay, so in this case, if you say that properties is the best investment, yes, you can have one or two, okay, just as a mix and balance in your portfolio. Okay, but don't go in, and do what, 60%, 80%, of your properties as your portfolio, then you might run into some problems later on. Yeah,
so
Rajen?
sorry. So what you're saying is not 60-80%, but it should be part of a portfolio, but not 60-80%, maybe 30, whatever, right? Depending, but kind of like a smaller portion. Rajen, I'm going to turn to you since you talked about commodities. There's a question here about commodities. I can't find the name of the individual, but never mind. It's about gold. Is it commodities as gold? I mean, gold is at high, kind of like very high time prices. Is it is it time to go to gold now, or because of all this uncertainty, or is it when does gold play a role in that portfolio? I understand what you're saying. Do the other things, asset classes first. Is gold last in your if you have extra cash and you don't know what to do with it? Is that gold the last one, or should it form part of your core portfolio?
I think you're quite right in saying it's probably going to be the last one. The fact is, gold will just sit there and it's not going to give you any money. Many years ago, I actually went through this silver phase and I bought a block of silver, brought it home, passed it to my wife, asked her, "Do you want this?" She said, "Nope." So I just stuck it inside a box or whatever, and we got robbed. And they took our silver bar away. And it's a great lesson, so it's not a problem.
Seriously?
So you got to understand that gold, silver are two of the four precious metals in that particular segment of commodities. All precious metals, when you talk about the market, are gold, silver, platinum, and palladium. I think there is a role for precious metals because as the value of fiat money continues to lose purchasing power, then having something that's precious can be useful. But I much prefer assets that actually put money in my pocket that can't be stolen by people who rob me blind in my house. And one year we got robbed twice. It's very depressing. After that, we put in lots of security and barbed wire, and it's much better now. So personally, because of the silver bar that was stolen, when I buy my gold right now, and I do hold gold, I actually buy paper gold. I have a public bank gold account, so I add a little bit to that. So it's okay, but I much prefer things that will actually put money in my pocket. Now, we're running out of time. So Roshan, would it be okay for me to run through the retirement calculation numbers right now?
Yeah, sure. Actually, it would be a nice note to end on, actually.
Okay, so let me just say this. This MCO has resulted in most of us being stuck at home. We are spending less money than we did before. Because we're spending less money, it's a great opportunity for us to rework our budgets and reduce the expenses. Now, you must understand that the less money we require to support our lifestyle after we stop work for good, the smaller the total aggregated asset base. Total aggregated asset base, TAAB, I'll call it TAB. Total aggregated asset base to fund retirement. Do not go and include your home there unless, as Selina mentioned, more to life. Roshan and I actually had fun because we did a joint thing with a friend with our friend Solon, who actually started More to Life. And so you may want to check that out if it's something, but unless you are planning to monetize your home, look at your asset base excluding your home. Now, I told you before that more than 85% of my clients have tab requirements of between 500,000 and 20 million ringgit. To calculate a person's target tab, several numerical assumptions need to be made before those numbers can be plugged either into a capital preservation or capital liquidation model. Capital preservation means that your asset base, your tab base is so large, you actually don't need to eat into principal as you live through retirement. And that means your money will last indefinitely, and you can actually leave that huge pile of assets to your children or to charities or whatever else. But most of us don't have enough money for capital preservation. We have to settle for a smaller capital liquidation portfolio. As my wife's uncle told me a long time ago, you got to book it, and then you potong book it to survive in retirement. And after a while, no more book it. And this particular uncle of hers retired decades ago, and he's still doing well. So I got to really take my hat off to him. Now, I hope you understand the importance of an income stream in retirement. And so you can either work on that yourself, or you may want to do that with a banker or with a trusted unit trust advisor, or with a licensed financial planner prior to retirement. Now, if the MCO helped you reduce your monthly budget expenses, and if you want 2 approximations of your capital preservation and capital liquidation tabs, total aggregated asset basis, drop me an email, care of BFM. Roshan, later you will flash it up, right? Care at BFM at ringgit@bfm.my. Ringgit@bfm.my. So Malek, Roshan, you better tell them what to put in the subject header. I don't know. Listeners, if you want this, email ringgit@bfm.my, but I need you to include in your email your approximate current monthly expenses, how much you're spending now, preferably with the post MCO reduction in your budget, and the number of years you have to go until retirement. Those are the only two metrics I need to look at. So it's going to be a very fast and dirty method of just giving you a couple of numbers, one for capital preservation, one for capital liquidation. Hopefully that is something useful that you can come away with. You can use that number as a start, and then you can work with a professional.
Rajen,
So essentially,
can I just ask you to repeat the two inputs you require?
Sure, including your, yes, thank you, Malek. Include in your email your approximate current monthly expenses. Approximate current monthly expenses. If you're listening in Malaysia, in ringgit, if you're listening from overseas, just give your base currency, Singapore dollar or US dollar or Aussie dollar or whatever else. Oh, Aussie, yes, Casey, one of my friends is listening from Australia, so hi. And also the number of years you still have to go until retirement. So let's say you're spending, prior to MCO, let's say you're spending 7,000 a month, and now you figured out a way to cut your expenses to 6,000 ringgit per month. And let's say you've got another 8 years to go before retirement, or another 18 years or whatever. Just give me those two metrics and I'll do a very simple calculation. I'll try my best to get back to you in about 5 days or so, if I don't get inundated with stuff.
All right, just send that over to ringgit@bfm.my. You can use the subject header Rajen Math, and we will and just include those two details there very simply, and we will get back to you as soon as we can. And on that note, I think Malek, do you have anything to add before I wrap up here?
No, I think it's just fantastic. Thank you. This is one of our highest engagement Facebook sessions. Fantastic. A lot of your questions. We can't get to everyone. I tried to take a few questions at a time, but I think I like to end it on this one note. I'm not sure why this question is asked, but just on this note, a guy called DU Andy George. Do you know Andy George, Rajen? He says, Rajen, does the southwest part of your house has any hole or opening on the ground? I'm not sure what that question is all about. It must be related to the burglaries that you've suffered or something like that. I'm not sure. Either is a feng shui master.
Not to the best of my knowledge, no. But I don't know where the southwest is. I've got to go and walk around with a compass.
Andy, I'll catch up with you on Facebook after this. I'm curious as to why you asked that question. Maybe you were the robber. Hopefully not. No libelous.
All right, and oh, okay. Before I lose it, I'd like to thank everyone for joining us today. And firstly, Selina, Rajen, thank you so much for joining us on this panel session and really giving us your insight. That it was quite jam-packed full of information. Malek, thank you for co-hosting this with me. And to everyone on Facebook Live, thank you so much for taking the time to join us today. If we've got a feedback form, which we will be putting in the comments later. So please let us know what you thought of this, whether you want more, what you want less of, things like that. And we've got more sessions coming your way. The next personal finance one is actually this Friday at 12:30 p.m. and we'll be talking about death, taxes, and the MCO. Yes, it sounds a bit negative and morbid, but the fact is this is very important information. These are things that are implications to you right now. And our tomorrow's session, our colleagues over at Enterprise, Frida Liu will be hosting a session called Making Tough Decisions with Employees. That's 12:30 p.m. tomorrow, May 6th, Wednesday. And she'll be speaking with Azman Osman Rani of Naluri, Deepa George of My HRC Services, and Sunita Ruthuram of Sunita Ruthuram and Co. So it's definitely another very timely topic to get into. And on that note, thank you so much to everyone for joining us today. We really appreciate your time. Let us know what you think over in the feedback form. That's it from us at BFM Radio. Catch you soon. Bye.
Bye-bye. Thank you.